Welcome back to The Explainer. Today, we are diving deep into a specific tax form, GST ITC-03. Now, this might sound a bit dry, but trust me, if you're ever thinking about changing your business's tax scheme, getting this right is absolutely crucial. And by the time we're done here, you'll know exactly what you need to do.
Okay, so let's just jump right into a situation you might find yourself in. Let's say you've decided to switch your business over to the composition scheme, to make your taxes a little simpler. Or maybe, out of the blue, the government decides your main product is now totally tax exempt. Great news, right? Well, yes, but it also creates this interesting little accounting puzzle. What do you do with all that input tax credit you've already claimed on the stock you have sitting in your warehouse? Because under the new rules, you're not really eligible for that credit anymore. Something's got to give.
And that's exactly where Form GST ITC-03 comes into the picture. Now, I want to be super clear about this. This form is not a penalty. Think of it more like an accounting adjustment. It's the official, by-the-books way to make sure you return any tax credit that, well, just doesn't apply to your business anymore. It's all about staying compliant when the game changes.
So here's how we're going to break it all down. First, we'll talk about the ITC reversal rule itself. Then we'll look at when you actually have to file this thing. After that, a step-by-step on how to file it, what happens after you've hit submit, and we'll even cover the nil return scenario. Let's get to it.
All right, first up, the ITC reversal rule. Let's get to the core of this whole thing.
So, what's the big idea here? Simply put, Form GST ITC-03 is how you pay back the input tax credit, or ITC, that you've already claimed on stuff you have on hand. Why? Because your business's new status, whether you're in the composition scheme or your products are now tax exempt, means you're just not eligible for that credit anymore. It's a way to true up the books.
And listen, we're not just talking about the raw materials sitting on a shelf somewhere. No, this covers the whole shebang. We're talking about the inputs you have in stock, the stuff that's already part of your semi-finished goods, what's in your finished products ready to ship, and it even includes the credit on your big-ticket items, your capital goods like plant and machinery.
Okay, so now you know what gets reversed. The next logical question is, of course, when do you actually have to file this form? Turns out there are two main triggers.
Trigger number one is a choice you make. You decide to opt for the composition scheme. Simple enough. Trigger number two is something that happens to you. The government suddenly makes your products completely tax exempt. But see, in both scenarios, the result is the same. You can't claim ITC anymore, which means you've got to give back what you already took. Now pay attention here because this is a really important difference. If you're opting for the composition scheme, that's something you do once per financial year, so one filing. But if your supplies become exempt because of a new rule, you have to file this form every single time a new exemption is announced for one of your products. It really shows how you've got to keep an eye on those government notifications. Okay, let's put this into a real-world context. Let's talk about Mr. A. He's running his business as a regular taxpayer, but he decides, you know what, starting April 1st, the composition scheme just makes more sense for him. So on March 31st, the day before the big switch, he does his homework. He calculates that he's got 40,000 rupees worth of ITC tied up in his stock and another 20,000 in his capital goods. So what's the damage? Well, the math is pretty easy. 40,000 plus 20,000, that's 60,000 rupees. That's the amount he has to reverse using Form ITC-03. And he can pay that right from his electronic credit ledger, assuming there's enough in there, or he'll have to use his cash ledger.
Okay, so we've covered the what, the why, and the when. Now for the really practical part, the how. Let's actually walk through the steps on the GST portal. And the good news is it's pretty straightforward. You just log into the GST portal, head over to Services, then click on Returns, and then you'll see ITC Forms. And boom, right there is Form GST ITC-03. Okay, now I need you to lean in for this one because this is super important. Once you click that Make Payment button, that's it. It's done. You cannot make any changes. It is final. So please, for the love of accounting, double-check, triple-check all your numbers before you click that button. There are no takebacks.
The last step is just to sign off on it. If you're a company or an LLP, you'll have to use a digital signature, or a DSC. For pretty much everyone else, individuals, other kinds of businesses, it's way simpler. You just use an EDC, which is basically an OTP they send to your phone. Easy peasy.
All right, you've done it. You triple-checked the numbers, you clicked Make Payment, and you authenticated the form. So what happens next?
Well, right away, the system will spit out an ARN, that's your application reference number, for your records. You'll also get a quick confirmation text and email. But here's the real kicker, and this is a big one. Any ITC that's left over in your electronic credit ledger after this payment, it's gone. It lapses, and I mean permanently. So thinking about when you make this switch is a huge part of your financial planning. You want to time it right to minimize that loss.
Okay, that's the standard procedure. But what about a scenario that's actually pretty common? What if you have to file this form, but you don't actually have any credit to reverse?
Right, it's a great question. Maybe you're switching schemes, but you literally have zero stock on hand. Or maybe you have stock, but you just never bothered to claim ITC on it in the first place. So can you just ignore the form? The answer is a hard no. You still have to do something.
And this is what we call filing a Nil ITC-03. So think about Ms. B here. She's switching to the composition scheme, but she never claimed any ITC. She still has to file the form, but she just puts in zeros. This basically tells the tax department, hey, I know I'm supposed to do this, but I have nothing to reverse. It checks the box, keeps you compliant, and you don't have to pay a thing.
All right, let's do a super quick summary. Form ITC-03, it's all about reversing your input tax credit. You use it when you switch to the composition scheme or your stuff becomes tax exempt. It covers everything, stock and capital goods. And the big impact? Any leftover ITC you have? Poof, it's gone. And don't forget, filing a nil return is a real thing, and sometimes it's exactly what you need to do.
And there you have it, Form GST ITC-03 all laid out. I think the big takeaway is that being compliant isn't just a reactive thing, like paying your taxes on time. It's about being proactive, especially when your business is changing. Which really just leaves us with one final question for you to think about. Is your business really prepared for these kinds of sudden changes that can hit your bottom line?